Good morning, everybody. It is Friday. It is July the 16th, and I am coming at you live from West Palm Beach in Florida today before I hit the road, and I'll be spending the weekend in Miami, which is just down the road from me. But in the meantime, I thought, everything around us is crashing, especially if you're an energy investor like I am. So I thought, why don't we take a few minutes and just get some perspective in terms of what is actually going on there. So I put together a short presentation, which I am hoping will be, at least educational in some way for you, and then at the same time provide some context to what it is that we're looking at. So just a couple of quick graphs. I'm not really a chartist, and one of the reasons why I'm not really a chartist is because charts always show me things that happened in the past, and I prefer to look at things that will happen in the future. Of course, I don't have the ability to predict what will happen in the future, but as a general rule, as a contrarian and as an optimist, I like looking forward as opposed to looking backwards. So that's my little disclaimer here, but I do want to show you. So just a couple of things, right? So I'm looking at a 10-day chart here of Occidental compared to two of its peers that are sort of similar, ConocoPhillips and EOG Resources. If you actually track the graph line of the past 10 days, you can see we hit a high, which was early in July. And I think that was when Oxy was at about close to $33 a share. And of course, right now it's down to like 26 bucks or something like that. So, this is sort of like a flash crash, right? The market generally, in the market, we talk about correction being a 10% decline. Well, the energy stocks are now way beyond that. But if you actually look at the trajectory of the chart for Occidental compared to Conoco and EOG, you can see that they are following more or less the same line. Occidental is the sort of fat line here at the bottom, the purple line, so it's kind of doing worse than the other two. But I just wanted to show you sort of at a quick glance, they are doing mostly the same kind of thing. How about comparing Oxy to two of the super majors in the United States? So Oxy, once again, is the fat purple line. And you can see there were a couple of extraordinary spikes, which were unusual in the past 10 days. Again, that's what I'm looking at, just 10 days. A couple of spikes over the last few days where Chevron actually sort of, to a degree, outperformed the other two. But once again, you can see the actual trajectory of the graph is mostly similar, regardless of the fact that we have WTI and Brent trading in the $70 range, which is good news for all of the five companies that I just mentioned. So Occidental, ConocoPhillips, EOG Resources, XOM, which is Exxon, and Chevron. If we look at the indices, and here I'm looking at a period of 1 year, you can see that we've been on a tear. So the NASDAQ is the orange line at the top here. It's been doing exceptionally well. And these spikes, these extraordinary spikes, are those sort of stay-at-home stocks that did really well during the pandemic. So they were looking at stocks like Zoom and WebEx and things like that. And of course, other online social media companies, Facebook, which I am not included in. I don't do Facebook, but I am on Twitter, which is where I usually go and rant. So if you get too upset with me saying things you don't like on my YouTube channel, then please don't follow me on Twitter, because that's even worse. So just stay away. But anyway, you can see that the market's been on a tear. Why has the market been on a tear, though? Mainly because the Fed has been printing money. And this is not a US problem. This is a Federal Reserve or central bank problem right across the world. In my neighboring country, just north of me, Canada, they've been doing even worse than what we are doing in the United States in terms of monetary supply and fiscal policy. It is off the charts. The amount of money that they're printing is putting us into an inflationary cycle, which is hyperinflation. I'm going to come back to that one in a minute. You cannot simply keep printing money. That's not a good thing to do. If we look at the sectors over the last 1 year or so, it doesn't look too bad. So for most of the people who follow my channel, you know that I have some diversification. As I speak to you right now, I have approximately a 42% weighting in energy. And over the past year, you can see that's up 32%. And then I have less than that, so maybe about in the mid 30s or so, 34, 35% weighting in financials. Those are my two largest sort of baskets of positions in terms of sectors, right? So I have almost half my investments in energy, and about a third of it in financials. And financials have done extraordinarily well. In fact, over the past 1 year, it's at the top of the sector performance at almost 50%. The other thing, just as an interesting point from a diversification point of view, is that my fifth largest position in my entire portfolio. Firstly, the first four are mostly energy and financials, but my fifth largest position overall is cash. So even though I have benefited from the market being up in this particular example here, almost 50% on financials and about 30% on energy, I still hold quite a large amount of cash, which I do just from the point of view of, firstly, a little bit of a safety net, because from time to time I need cash. And secondly, also to have some dry powder ready in the event that something pulls back sharply. So on our channel, somebody said, "I wish or maybe Oxy pulls back to $10 a share, then I can buy myself another few thousand shares." Well, that would be nice if you could buy Occidental at $10 per share, but it would be horrible if Occidental actually goes to $10 a share. So it's kind of like a little bit of mixed emotion on that one. How about for the past week? And this is where we as energy investors got hurt the most. Energy is the bottom performing sector of the past 1 week at an almost 5% decline. Now, in the instance of some of the stocks that I hold, like Occidental, it's actually a correction. So most of my small cap energy stocks, which I'm not really talking about here, which includes my uranium positions, and for sure Occidental, Energy Transfer has taken a bit of a hit as well. Those are actually sort of beyond correction territory, so they're down more than 10%. My financials, of course, on the other hand, have not been doing too badly. In fact, some of them over the last week or so have actually gone up instead of down. So there are benefits to diversification. And once again, I'm not giving you advice. I'm just sharing with you what it is that I do. If I look at the actual companies and sub-industries within the industry, and here I'm specifically looking at the energy sector as a whole, and I'm looking at what the analysts and the research team rating says overall in terms of the entire sub-industry breakdown, they currently say there are only two companies that you could possibly accumulate. Everything else below that, it is either a hold or a sell. So right now, right at the top of the list is Cheniere, and then there are only two that they list as potential buys. So let's take a quick look. Oh, by the way, the second one is Bonanza Creek. I don't know anything about Bonanza Creek. I do know a little bit about Cheniere. But let's take a quick look at the snapshot of Cheniere. Currently trading at around $42 a share. This is a mid-cap sized company, mid-cap value. It has a market cap or market valuation of approximately $20 billion. So it's by no means a small company. Its 52-week range is $31 to $45. So unlike some of the energy stocks, it has not pulled back quite significantly from the high, where it was trading just a few days ago at around $45, and now it's at $42 per share. The PE ratio of 22, so the forward ratio for price earnings at 22 is a little bit too rich for me. I usually want to look at getting into a new company if I'm going to open a new position at a PE of 15 or lower. Why? Because 15 is sort of the average of the S&P 500, which I use as a benchmark. So in other words, I want to get into something that is, relatively speaking, less expensive than the average of the S&P 500. But you have to be cautious, because if the company's PE ratio is 1 or 2 or 5, that doesn't mean it's necessarily a good investment, because there might be some underlying fundamentals that make it a terrible investment. So you need to do a little bit of homework on that one. The other thing that's nice about Cheniere for people who are looking for some ongoing passive income is that it currently offers a dividend of $2.64, which at the current price of $42.65 yields 6.18%. It's a nice, fat, rich dividend. It's not dissimilar to Energy Transfer. Originally, when I opened my position in Energy Transfer, I was thinking, well, I can park some cash in Energy Transfer. It also pays a nice big dividend. A quick look here. I talked about this in several videos, and I'm going to just mention it again. The inflation pressure as a result of the Fed's unbridled appetite for printing money is impacting us all. This is from MarketWatch, US inflation pressure, 12-month rate of inflation. CPI, the consumer price index, shows you a risk of around 5, 4.5, 5, and the average is around 1. How about the consumer price index for food and energy, which is core to what we do every single day, right? We all need to eat and we all need to move around. So, and that's why I sometimes say everything you touch, feel, smell, or whatever is going to cost you more money. Almost edging up here to 4 with a 10-year average of just over 1. This is not a good picture. This is not something we want to see. By the way, the VIX, which is the volatility index, the VIX, you can look it up, is under 20. So there's not a lot of volatility fear in the marketplace. You usually see the VIX spike when people are fearful in the marketplace. So right now, we're not actually at that particular level at this moment in time. PCE is personal consumption expenditures. The risk level is about 3. The Fed target is 1, and the 10-year average is below 1. And if you look at core PCE, which is personal consumption, that same index minus food, then it is just a little bit less. By the way, these graphs come from the Bureau of Labor Statistics. So, of course, I didn't make the graphs, and I'm assuming that my source is at least somewhat reliable. Just a couple of things here to end this video with. Holger wrote to me where he wrote a comment on the channel, so anyone can read it. But he highlighted for me something that kind of I was sort of aware of it, but I didn't really pay attention to it, and it was just something that happened sort of over there, in the distance. And sometimes we're very insular. And when I say we, maybe I'm speaking for all of us. I'm not sure, but sometimes everything that happens is here and now, sort of locally where you are. That may be in your city or your state or your country. Or, in other words, when I speak of the Fed, I'm usually talking about the U.S. Federal Reserve. When I talk about the market, I'm talking about the NASDAQ, the Dow, etc. Holger reminded me just yesterday we faced another never ever experience in terms of a natural disaster in Europe. Holger, thank you for reminding us that this happened. More than 60 were dead and dozens missing amid severe flooding in Germany and Belgium. Our thoughts are with you. Godspeed. I hope that you have a good recovery year. Nothing can replace what you've lost. And that is unfortunately the sad truth of life. But it's a horrible story. Intense rain collapsed houses and caused riverbanks and reservoirs to burst. And of course, we all have experienced flooding before, but this is horrific. It's not a good story. Holger, my best to you and everyone in Germany. We have quite a lot of people following from Germany. One of the people who interact with us frequently is Dr. Matthias Kunke. So my best regards and wishes to all of you. I want to end this on a little high note here, give you a little bit of positivity going into the weekend. Energy, electricity demand will rebound. The electricity demand rebound will require more fossil fuel generation, says another, I guess, reasonably reliable source, the IEA. What did they say exactly? Global electricity demand is growing faster than renewable energy and will require more power to be generated from the burning of fossil fuels. Now, I'm not particularly happy about the burning of fossil fuels because that's kind of like saying I'm happy about something that's supposedly bad. And that's not my intent. But the International Energy Agency says we will need to burn more fossil fuels in order to create energy. They go on to say power consumption is set to grow by close to 5% in 2021 and 4% in 2022 as economies recover. Now, of course, they don't know that. That's their forecast. And there's a good chance that they may be mostly correct, because I think it's fair to say that from a macro thesis point of view, there's a greater chance of recovery than what there is right now of a devastating second round of a pandemic or something like that. And I say that in hope and say that hopefully for the benefit of anyone who is watching this right now. Nearly half of the increase will have to be met by burning fossil fuels. It might even be more than that, but we'll see how we go, because the traditional renewable energy sources like solar and wind unfortunately underperform fabulously. So we're going to have to see how they go on that one. And particularly strong demand in the Asia Pacific region, primarily China and India. Now, of course, we pretty much already know this as energy investors, that demand is on the increase. We see the effect and the impact of the pandemic slowly subsiding. And by the way, when I make comments related to that, it's not related to the fact that there's no pandemic, or it's not a threat to humankind, or whatever the case might be. I'm just sharing with you my personal take in terms of where we are and my personal experience. If that offends you, I can't help that. But what I share with you is honest, it's from the heart. I am hoping, and I have friends and family all over the world, and they are impacted by the coronavirus in different ways. Mostly, fortunately, not so much in terms of getting sick, but rather in terms of being locked down, their businesses struggling or collapsing, or whatever the case might be. That is the horrible byproduct of the coronavirus pandemic. But I'm hoping, and I'm reasonably confident, and I am an optimist, that we've kind of seen the back of it. Over the next few months or so, I think the threat will dissipate and things will return to normal. If you're in energy, you're going to have to be very, very strong in terms of how you manage your positions right now. There's going to be a lot of volatility. There's a lot of emotion, right? When the stocks go up, we're all happy. And when the stocks go down, we're all sad. We're just human, right? If you're in energy, now's not a time that you necessarily want to sell. Maybe you want to hold. Maybe you want to nibble a little bit, buy some. I don't know. You got to do what's right for you. And I don't know your personal financial situation. So please don't ask me for advice. But what I'm doing right now is I have a basket of energy stocks. I have a basket of small cap energy stocks, which is mainly uranium and rare earth elements and related type of investments. I'm just holding them. So I'm not necessarily in a buying mode or buying mindset. If things were to change, I will change my thesis. In the same way, right now that I'm comfortable holding, for instance, my energy and financial stocks, if the macro thesis changes and I need to get out, I will get out. I will move. So you need to do what's right for you, and you need to do your homework, and hopefully some content that you consume in terms of even this type of video is beneficial to you and helpful to you. And guys, on that note, this is Mr. Roxy, or otherwise you can just call me Rudy, for Best Your Investor, signing off, saying have a great weekend, and I'll probably see you guys next week. Bye-bye.